Hey, welcome back, everybody, to the Today's Market Explained podcast. This is a market commentary podcast. We just finished some interesting interviews, and we'll come back to that. But for now, we're going to talk about what's going on with this market. We did a review of the markets here a couple of weeks ago, just as we completed the year of 2022. Now we're into 2023, and we're going to talk a little bit about what's starting to happen. And I will say that we have now been heard on Antarctica. We had a vacationer, a friend of Four Star, who was down in Antarctica and managed to listen to the podcast just off the coast of Antarctica. I think there's no Wi-Fi on Antarctica, but nonetheless, this gentleman did. And so thank you very much, Mr. Steve Baird from Baird and Warner, listened to our podcast down there. So now we've been heard, Chris, on 7 continents. And let's get going with our next episode. Welcome to my partner, Chris Reardon. Chris, welcome to the podcast.
Thanks, Brian. Glad to be here. Good afternoon to everyone, and glad to talk a little bit about the markets.
And Chris is our 4-star director of development, master of all things portfolio, and loves his Cleveland Indians. He's a father of 3 young children under 2 years old. Oh, my goodness. Chris, thank you for being with us here at the podcast.
Thanks again, Brian.
And I'm Brian Kasal. I'm the CEO and founder of 4-Star. I'm an Eagle Scout, trustee of the National Boy Scout Foundation. I'm the chief dad to Quinn and Evan, and the husband to the amazing Tripty. Let me just say, everybody, if you like what you're hearing, please give us a 5 out of 5 and forward this episode to some of your friends so they can listen and hear what we're talking about. There's a lot of really interesting things to say about what's going on in the financial markets today. Very confusing time, very interesting time. We're going to talk about the markets, Chris, and then we're going to talk about the economy, some general ideas about what we see out there. So, Chris, let's talk about our positioning in the markets right now. Where are we? Where are the rankings between 1 and 6? What's working and what's not?
Yeah, thanks, Brian. So we had a bit of a switch up in the number 1 position. So international equities took over the number 1 position from cash. It actually gained 33 points since the last podcast, which was January 5th to reference, to 240 tally points now. So I took over that 1 spot there. Cash dropped to 2. It lost 17 points, and it's at 218 tally points now. So a switch at that top point. Commodities is still holding the number 3 spot. It lost 1 point, so it's been relatively stable. It's at 180. Domestic equities lost 3 points. It's at 175 in the 4th position. Then fixed income lost 10 points, and it's at 149 in the 5th. And last is still currencies. In 6th, it's lost 3 points, and it's at 128. So the biggest news was really that flip between cash and international equities. In many ways, a lot of that was about China reopening, loosening some of their COVID policies. That obviously spurs a lot of potential demand if they're going to be able to start traveling, things like that. And I think there's also been some optimism in the EU, European Union, over how long the recession over there will be and if it'll be less than expected. So there's some optimism on the international front that's driving that, but we'll see if that stands true moving forward.
So, Chris, this is a really interesting set of circumstances. So international equities, as you say, gained dramatically. The dollar's been a little weaker, the opening of China. So international equities, in stocks of companies overseas, haven't been in the number 1 position since 2007. It's a long time. So you can't say how strange that is. And a lot of that, of course, has to do with that our stocks aren't doing as well. We had a rough year in 2022. Commodities had a strong year, but then have since faded a bit. So commodities, cash, and domestic equities are really close to each other in tally scores, so there'll be a little bit of movement between them. But clearly, in number 1 position was international equities, and that is, again, a very strange occurrence because we haven't seen that in a long time. Now, we have seen international equities rally a couple of times in the last 15 years and then fade very quickly. So we haven't seen the sustained rally in international equities since the period between 2002 and 2007, when international stocks and commodities outperformed U.S. stocks for that whole 5-year period of time. So maybe we're going into a period of time like that again, maybe not, but international equities right now are clearly in the lead.
Yeah. Yeah. I mean, I think the other thing to point out too is commodities, even though it's in the third position. I mean, just like you said, as quickly as international could collapse, we could see commodities vault right back up. I mean, I think that just shows just really the volatility and the unpredictability of the current market we're in. China opening, a lot of people point to that as another potentially another run for commodities. So we could see that potentially boost commodities back up as they're spending. You have the impact on oil, impact on potential building there, things like that. So just, what I would stress is it's still a very volatile market. I think really in those top four asset classes, international cash, commodities, and domestic equities, in a month or less period, we could easily see any one of those retake that number one position.
Right. And as you said, commodities were really the story of last year, Chris, the 2022 market. The only thing that really worked were commodities and inverse investments, obviously, but that's the negative on the markets. And we saw certain individual commodities like nickel, and then strong broad-based groups like agriculture, and then all oil-related, energy-related commodities did very well. But it was only about a 5 to 6 month move. Then it started to fade in the second half of the year, but a lot of gains remained in commodities. And so if anybody was in a rotation model that had commodities, they did very well. We have one at 4-star that was not down much for the year when the markets were down dramatically, down 19% on the S&P, 33% on the NASDAQ. And then many of the large techs were down even more than that. So the secret to making any kind of return or not losing was commodities last year. So maybe this year it could be international. Maybe commodities come back. Who knows? We are in a very sloppy market, Chris. We have a bunch of big up days, then a bunch of down days. Today, Intel is down 10% on a big earnings miss. So we seem to go back and forth. We're off the bottoms, but we're still not looking at any serious direction either way. So let's talk about what we think will happen. But let me first comment on a couple of things that happened last year that were first. So in 2022, the portfolios that go to maximum cash protection had to go there twice last year. Now, in my entire career as a portfolio manager, we've only gone to maximum cash, Chris, and protection 7 times. But 2 of those times happened last year because of the volatility. So that was the first time we ever did that twice in 1 year. And that'll just show you how wild the volatility was. The markets would correct and go to a new low, and then they would rally 20%, and then they would correct again and go lower. Did that 3 times last year. So that just shows you what a crazy time it was. And then also, I'm going to put up on the screen a chart that shows what the markets have done over history. And to show you how different last year was, on the screen, there's a chart that shows the stock market total return, either positive or negative, and then the bond market total return, either positive or negative. And if you can see in the upper right quadrant, most of the dots are in the box where it says the stock market was up and the bond market was up, and each dot represents 1 year. So most of the items are in this upper right box. That's the normal condition of the markets. Usually stock market's going up and the bond market is giving positive returns through interest and not losing value. Then if you look at the upper left, that's where the stock market is down, but the bond market is up. That's the second highest distribution of returns, but significantly less than the double up. And then over to the bottom right, we see 5 years only where the bond market was down. The bond market generally doesn't go down very much, but the stock market was up. So this little box over here on the lower left, which means both the stock market and bond market were down, only had 0 instances up until last year. So last year was the first year in which both the stock and the bond market were down in American history, or at least in modern finance industry history. So now we're looking at, why did that happen? Of course, interest rates spiked up so sharply that the bond market really literally collapsed. And it was the worst bond market on record in American history, down 12%. The stock market was down close to 20% on the broad index, and then the technology index down 33%. Many of the big tech stocks were down even more. So it was a very, very rough year for investors. So I call it a year of firsts. And so we went to cash twice because of all this volatility. And then also we saw the markets both go down for the first time in American history. So there's been a lot of pain out there, Chris. Let me tell you, a lot of investors down 20, 30%. And a lot of retirement plans might change. A lot of investors might have to change their whole program based on what happened last year. So we're proud to tell everyone that 4-star investors with our rotation models did not sustain as big of a big decline. Most of our investors no more than a single-digit decline because we did have the 4-star protection plan and the rotation models in place, and we sustained much less downside than most investors. So we're very proud of that. But hopefully things have bottomed or we're getting close to a new bottom and then we can move on. The good news, Chris, is that we've never seen a perpetual bear market. Bear markets do end. And whether we've already bottomed back in October and we're just kind of trading around here for a while, or maybe we go to another new low, that low will probably be the end of this bear market and then we'll start heading upward. So we're looking at a lot of interesting things in the economy that will determine probably what the markets will do. So Chris, why don't we go through what you saw just this week in the economy?
Yeah, so just a couple highlights of economic data that came out. The biggest, I would say, is the GDP number we got for the Q4 or the last quarter of 2022. It came in at 2.9%, which was a slight slowdown from the Q3 number that was 3.2%. Biggest driver behind that was consumer spending. So I think the positive aspect of that is we didn't see a huge drop there on GDP yet, but I guess some of the consumer spending, some of the underlying drivers as that quarter went on, so October, November, December, were weakening more. So we could see a weaker than expected or a much weaker number in Q1 potentially of this year, 2023. So the personal consumption expenditures price index, which is what the Federal Reserve really likes to use for their inflation measure. It's known as the PCE price index. It rose 5% in December year over year, and that's a slowdown from the 5.5% year over year increase in November. So about a 0.5% slowdown there. So we continue to see that inflation number slow down slightly, although their target, the Federal Reserve's still stated target is 2%. So that's still 3% above where they would like inflation to be. The producer price index rose 6.2% year over year in December. That was the slowest annual rate of increase since March of 2021. So that's positive. That means on the supplier side, we're starting to see costs come down. Usually that gets translated to the purchasing side or the consumer spending side. So on both fronts, really, we're seeing inflation continue to slow. Most of that was expected. Maybe we'll see spikes here and there, but overall, the trend has been down, which is positive. Purchases at stores, restaurants, and online declined a seasonally adjusted 1.1% in December from November, so month over month. And then spending by U.S. households decreased 0.2% in December from November. So that's that trend potentially impacting the GDP coming into Q1 2023. If those trends continue and consumer spending, household spending continues to move downwards, that is going to have a big impact on GDP. It's has the biggest contribution to that GDP calculation. So keep an eye out on that. On the positive front, the University of Michigan's Consumer Sentiment Index rose nearly 9% to 64.9 in January from 59.7 in December. And that's the highest reading since April of 2022. Positive there. I think what we're getting this read, and I think some of the volatility and some of the craziness in the market right now is you have a lot of people that are starting to get a little bit more positive sentiment because they see the Federal Reserve potentially slowing the rate hikes or stopping altogether. And then they're looking out a year in the future or even towards the tail end of this year and projecting even, or they're thinking even that are they going to start lowering rates potentially, and the impact that could have? So we're already getting, as humans, we like to be optimistic. We like to look forward. We're already seeing people kind of project out and feel a little bit more optimistic. Once again, 64.9 is still pretty low. If we go back to even pre-pandemic or in like 2021, I mean, we were in the 80s and 90s, at some points even over 100. So still low, but it's positive that we're starting to see it tick up again. So that's positive. And then the last tidbit I have is the sales of previously owned homes slid 17.8% in 2022 from 2021 year over year.
Nice. Well, now you also talked a little bit about what's going on with China, Chris, and that's interesting because China was one of the strongest growth markets for a long time, but now some of their demographics are taking over, right?
Yeah. So this was, really, really big news. China's population fell roughly 850,000 people to 1.4 billion in 2022. Which, 850,000 out of 1.4 billion doesn't seem like a lot, but that was the first decline in the Chinese population since 1961. A lot of this was due to the one-child policy that China enacted due to concerns of overpopulation. And then once you add in certain cultural aspects of the Chinese cultural, a lot of in China, it's a lot better to have a boy, just like kind of from the cultural perspective there. So you had, demographics skewing towards male rather than female, as people would try just for a boy instead of a girl. So, their population is really became skewed off of that. And then on top of that, they have a very, very large elderly population as well. So, there's concerns, and that's been brought out. I know I've seen a couple articles on it so far to start 2023, but concerns about what that could mean for China down the line. And then on top of that, if the trends do continue, India could overtake China as the most populous country in the world as early as next year. So, we could see that number one population title move from China to India fairly soon.
And it's interesting now, the Biden administration has also made some moves to restrict mining, I believe.
Yeah. So it was actually, I think that came out this week. The Biden administration moved to block mining in northern Minnesota for about 20 years. It's really interesting. We've talked about this a little bit on the podcast. We're not necessarily against green energy, but doing it in a rational way with a rational timeline and actual plan is very important because just throwing irrational numbers out there doesn't do anything. And, we know this administration is very passionate about, electric vehicles, wind power, solar power, things like that, but if you're going to have these and have very, very aggressive initiatives, you're going to need copper and nickel, and this area of northern Minnesota, the development that was going to happen was a copper and nickel mine. So it's kind of, I don't know where they're going with it, because it's kind of, you're pushing one thing, but then you're choking off the points needed to actually attain those goals. So it's really just running in circles and a lot of posturing in my mind to make it seem like they're trying to do a lot when there's really no plan behind it, rational plan at least.
Well, there's been a ton of job cuts. I'm going to talk a little bit about technology in a minute, but Chris, some other companies now are cutting as well.
Yeah, so Hasbro came out this week. They had bad earnings this week, and they came out with plans to cut 15% of their global workforce. So we've seen and we've talked, I think, on previous podcast episodes about some of the cuts we've seen. Mostly they were in the tech world. That's where the biggest ones came. I think almost every big tech company had major layoffs. Google was in the news heavily in the last week because they had a huge reduction of workforce. I think something around 20,000 employees were let go, and it was pretty much just slash and burn across the company. So, but Hasbro is obviously not considered mostly a tech company, really. And they're cutting 15% of their workforce. So, this is to be expected. And I think one important thing to point out, Brian, like you said, recessions, if you will, are cyclical. So we have, markets, most likely if we're in a recession now, we have the earnings coming out now, and we were kind of projecting this a little bit kind of towards the end of 2022 that we really need this earnings adjustment period. And that's what we're seeing now. We're seeing a lot of bad earnings, a lot of bad projections. So what's going to start to happen is then the next earnings cycle, so Q2 and then even into Q3 of 2023, we're going to start revising those earnings down. And then once they get revised down, and hopefully at some point base and start moving upwards again, that's when most likely we'll start to see the market bottom potentially and start to move upwards strongly. So, but on the flip side, like Brian's talked about, is not every area is getting hit. Chipotle, in fact, plans to hire 15,000 people in the U.S. as they're seeing their business increase in the coming months. So, each sector, I know restaurants even, each sector isn't getting hit equally, if you will. So really interesting on that front. And one other thing I'll mention is Bed Bath & Beyond, which we've talked about here, as getting close to bankruptcy. They're kind of dwindling back and forth. Well, they've been cut off from their credit lines as several other banks have determined they've defaulted. So they're getting pushed closer and closer to bankruptcy at this point, most likely, unless there's some kind of saving grace at the end there, are going to have to declare bankruptcy. So they'll go through that process. I think it's another important thing to highlight that bankruptcy doesn't necessarily mean that the company is going to go away. They could restructure it, streamline it. You could see a lot of stores close and then optimize it. So we'll see what ultimately happens to Bed Bath & Beyond through this process, but most likely at this point, it looks like they're going to have to declare bankruptcy.
So, Chris, you mentioned about how Chipotle is doing some hiring. And so while we're seeing an economic slowdown in America, and we saw that most of last year, while the first quarter of last year and second quarter were down, third quarter was up over 2%, but the domestic economy was down where all the growth was in exports. A little different here in the fourth quarter, but now with all the layoffs and all the predictions, earnings are down 4.8% for the S&P for the first quarter. So looks like things are slowing down. At the same time, there's some very strange things happening. We're seeing a near record travel boom. Try getting a hotel room in the Bahamas right now. Try finding a round trip air flight anywhere in America for less than $200. I don't think it's available anymore. So prices are going up, people are traveling, and this we think is probably a pandemic effect where many other functions of life have come back, but yet many people from the pandemic were still concerned about travel. So since Thanksgiving, there's been an enormous travel boom above 2019 levels. And so that's a positive. There's also enormous amounts of R&D and production roles in the healthcare industry that are growing nicely. So while we're seeing all these slowdowns in the real estate markets and the interest rate effects, we're also seeing some big growth areas. So there are a lot of prognosticators and market commentators predicting a big wipeout in the market, a big earnings downturn, one of the worst recessions ever. When you see things like that, that gives you pause and think, well, maybe there will be a recession in certain areas, but maybe certain areas won't be as bad as people think. So we're kind of in that camp where, we could have a bad recession here in 2023, but with some of the things we're seeing, there's a decent chance that it's not as bad as people think. So we'll keep watching and see what evidence we get over time to see if that's true. But we're obviously hoping so we don't have a big economic downturn. But at least we're seeing some signs that might be possible. Now, as far as the election season has changed many things. And one of the things they changed is now there's an opposition party. We talk about gridlock. Sometimes gridlock is the best thing, where there's two different parties that have two different views of things, and they're both bringing their ideas to the fore. One of the things that's happening with the change in party in the Congress is that they're launching investigations and suits against tech companies. Chris, isn't there a investigation on Google?
So the government filed an antitrust lawsuit against Google this week, trying to compel the company to divest part of their advertising technology unit, which back in 2021, this unit comprised about 12%, so a decent chunk of Google's revenues. So, and this has been an ongoing thing. I think that it's still going to continue to be in the limelight, that, you have these massive tech companies, Facebook, Google, that have responsibilities in some cases to the public and things like that. So it'll be interesting. I think that this has been, I wouldn't say a fear, but this has definitely been something people have seen kind of coming down the pipeline potentially, that maybe these companies will need to be broken up or have other regulations put on them. And I know it's been one of the few bipartisan objectives, if you will, by Congress is going after some of these bigger tech companies. So yeah, no surprise, but it'll be interesting to kind of see. I'm sure Google's going to fight it to see kind of what the overall outcome is.
Well, and there is obviously a sell-off going in the tech industry, in the stock market, sure, and there's been massive layoffs announced in tech, but don't forget there are massive employment roles also in the tech industry. So even with all the layoffs that have been announced, tech unemployment is still only at about 2%. So most of the layoffs in technology have been surrounding e-commerce. So we're seeing another little strange mini trend with people slowing down on e-commerce. And we're also seeing a little tick up in stores as, once again, pandemic effect. People have avoided stores wearing masks and things like that, even though the pandemic has been pretty much over. But many people were still cautious. So now it's this Christmas season, there were more people going to stores than in a long time. So we're seeing a little mini trend change there as well. And then also in the software area, they're still hiring software engineers. The driver of much efficiency in business is often technology. We see it in our business. We see so many ways that things used to be on paper. Now they're in computers. We're able to handle more things, much more efficient. So there's still a lot there for technology and software developers, for example, but we're seeing a change in employment. We'll see if that tech unemployment goes higher. We'll see if the layoffs continue. And so we'll be back with more information on that. So a lot of cross currents, Chris, a lot of strange things going on in the economy. So maybe we're hoping that it's not as bad of an economic downturn. And if that was the case, then maybe the markets have already bottomed with 3,500 on the S&P back in October, and then we'll march up from here. Or maybe we do have another leg down. We'll just see how the news flows out, see if we have any more wars. There's been threats of a war in Taiwan, with China going to Taiwan. So any of those things could tank the stock market, if there's concern out there. There was also an interesting thing. There's a bug infestation in Queensland, Australia, wiping out the entire sugar crop of Australia. And so now there might be a spike in sugar costs. So get ready to pay more for your Coca-Cola and all your sugary drinks. So anyway, that's really it for the economy. Had a couple comments about what's going on in the political world, Chris, that can affect the economy. Now we're hearing a number of false claims from our president again. Unfortunately, he mentioned the other day wages growing higher than inflation. Well, that's a false claim. Wages aren't growing that fast. Inflation is higher than it has been in a long time, but it is decelerating. It is coming down, but it's still quite high. We're still in the 5s and 6s. We had been in the 9% range last June. So it is getting better, but there's a lot of misinformation being spread out there. We did see at the beginning of the year a battle for the speakership in Congress. And I wanted to comment on that because it is important that even though the new Congress has come in with a different party, the members of that caucus did call their potential speaker candidate to the carpet and say, hey, we want some changes. We want Congress to run better. We want bills to sit on the floor for 72 hours so people can actually read them. We want more controls on spending. So even though many of the people in the party generally supported the gentleman, Kevin McCarthy, who's come the speaker, the fact that they did actually force some reforms can only be good for the Congress. In recent years, the Congress was voting by proxy. They weren't engaged at all. They were overspending. And so maybe a lot of those reforms will help America and help America grow better and make sure that we maintain our competitiveness. Now, one thing that we are very concerned about is the debt. Now, we're in the middle of a big debt ceiling battle. And of course, this has happened a couple hundred times in the last 40 or 50 years where Congress has to raise the debt ceiling. And the reason they have a ceiling is they want to make sure that we're aware that the debt is going up and we try to take some action to arrest that debt, Chris. Now, the thing is, there is a crowd that are saying we need to raise the debt ceiling without any changes because we're risking the full faith and credit of the U.S. government if we don't pay our bills. Well, and I do believe that the crew that is trying to make some changes is not trying to cause the full faith and credit to be at risk. But yet, this is a good time to look at your credit. If you're maxing out on your credit cards, and you're able to get another credit line to go up, maybe you're going to hit that credit line and keep going, and it'll never end. So maybe this is a good time to take a look at what reforms can we bring to our spending. We've spent record levels. We've added $10 trillion in debt through the pandemic period of time, which maybe we needed to because we went through a very difficult time in the country. But now we need to stop that adding debt. We had $5 trillion in debt in over 200 years of our country's existence up until the Bush administration, $5 trillion in debt. And then it's gone up now to $31 trillion in just about a 20-year period of time. So it's really chronic. It's existential. We need to solve it. We need to solve it now. But just going on and raising the debt ceiling without reforming anything, that's the irresponsible thing. I think this is a good time to step back and say, what are we doing now? Interest rates are higher, so our debt cost is going to be higher. That's going to cause more spending. What can we do to reduce that and get that back in line? I will assure you that if we do not make reforms to our spending, we will threaten the full faith and credit of the U.S. government if we don't solve our spending problem. We don't have a revenue problem. We have a spending problem. And we spend too much. We spend much more than we bring in. And that needs to stop, or it's existential. It could mean a currency crisis, could mean a debt crisis for America, and could suffer a sovereignty issue as well. America could be at risk itself. So we're here to advocate. It's time to do something about the debt and use the debt ceiling time as a way to take a look at what we're doing and make sure we make some changes so we don't spiral out of control and then America might not even exist at some point. So Chris, that is all we have for today. I know we have a couple of blog posts out there. We have one about going to Mars, so have a look at that. Also up on the 4-Star site, we've got all the interviews. You can look at also at Stitcher, Spotify, and all the other podcast services. We just did an interview with a very interesting entrepreneur, Todd Ernest, who started from no college education, no formal training, and he's built a national company in HVAC and refrigeration. So you can still make it in America without a college degree. Everybody's got to go to college and take on hundreds of thousands of debt just to succeed. Well, maybe not so. Maybe people can be in the trades as well and do very, very well. So do listen to that interview with Todd Ernest. It was quite good. Chris, I think that's all we have for today, huh?
Yeah, I think that about covers it for the end of January.
All right. Well, for my friend Chris Reardon, for our whole team in Chicago, Laura, Chris, Jonathan, our team on the East Coast, Karen, Tucker, and Brian, and all the great 4-Star advisors, we'll leave it there for today. We'll be back again with another episode. Thanks, everybody, for being with us on today's Market Explained, the 4-Star media event, video, and podcast series. Thanks again, everybody.